Okay, guys, today we're going to talk about the last part of topic 8. So we're going to talk about the exit strategy of venture capitalists and then IPO. So there are 4 general methods that venture capitalists can exit from their investment. The first one is the initial public offering, right? So venture capitalists, they can directly push the firm or help the startup firm to go IPO. The second one is private sale, meaning that you can be venture capitalists, they can sell the company to another party. So because they are selling a private firm, that's why it's called private sale, right? Third, sell back, right? Sell back meaning that they can sell back the company to the entrepreneur. And the fourth one, usually when the VC investment fails, right? When the startup fails, in our case, VC have to reorganize and liquidate the company. So initial public offering, it's the most ideal strategy for the venture capitalist. It is also the most profitable exit strategy. So in IPO, firms goes from being a private firm to public firm, and firms go on public to raise more capital and sell existing shares. And because if you go IPO, VCs can earn a lot from the exit. That's why initial public offering it's considered the best way for VCs to exit. And what is the initial public offering? Usually, during the IPO process, that the firm goes from private to public, and then there'll be new shares uh, issued during the process, and also so no shares may be sold, but all shares are publicly listed and traded. And in this exit process, VCs, they're only allowed to sell shares only after the listing. They're only when the firm has gone public, then the VCs will be allowed to sell the share. So the reason why firms want to go IPO, it's because the public market has some uh, benefits for the company's financial. For example, the public company creates liquidity. That's meaning that the firm can sell shares. The firm can also sell the assets in the public market. So this creates liquidity for their shares. And also, the public market reduces information asymmetry. So because during the IPO process, the IPO firm has to disclose in greater detail about their businesses, right? So that's why the strict disclosure requirements help reduce the information asymmetry. The second way to exit from an invested firm is selling the investment to a private buyer, and this buyer can be strategic buyer or financial buyer. Now, so in this case, we will be in a merger acquisition case, right? So if it's a strategic buyer, we know this in M&A, right? So if it's a strategic buyer, they're usually looking for the strategic value of the firm, not the financial value. So strategic buyers, they're usually another firm. For example, it could be competitors, partners, or firms in the same supply chain, or firms in the same product market, for example. So they usually have some sort of business relationship with which would allow it to create synergies by acquiring the firm. Right? And the firm is more valuable in the hands of another firm than it is by itself, right? Because if a public firm or if it's another firm buying this private firm, the managers could be better, right? For example. And also there could be synergies, right? So the typical synergies we talk about in merger acquisition also apply here. And also strategic buyers, they're willing to pay more, right? Because they can achieve potential synergy. This synergy can create lots of cost saving, revenue enhancement, right? And in this case, if it's a merger acquisition case, then they will usually seek 100% of the stock, right? They want to fully control the firm. On the other hand, financial buyers, they're usually other VC funds, leverage buyout funds, or hedge funds. And they're willing to buy only part of the firm. because they want to spread out the risk, right? But at the same time, they are also aggressive buyers, right? And because they are only looking at the financial value, that's why they don't create, right? They don't create synergy. And therefore, they do not value potential operating synergy, right? They only look at the financial value of the firm. Or in other words, they only focus on the operating synergy, but not financial synergy. Oh, sorry. They only focus on the financial synergy, but not operating synergy. This is financial buy. And there's three types of private sale transaction. So this just basic forms of merger acquisition, depending on different consideration. So the company could be sold for cash. That's the most desirable uh, type of private sale transaction. And if the company is sold for cash, then it triggers capital gain taxes. So this we have covered when we talk about different considerations of merger acquisition. And also, the second type is selling stocks for debt instrument, right? So this convert equity for debt. Right? And usually VCs, in that case, they get a face value at a specified date. But if you sell the stock for debt instrument, then the firm will be subject to bankruptcy risk because all of a sudden it has undertaken lots of debt. But on the other hand, it might extract better prices. Right? Because it's a selling stock for debt instrument. In that case, this type of transaction does not trigger capital gain tax. Right? In other words, you can think about this as a recapitalization of a firm. And the third one is called selling stock for stock, right? This is a typical stock for stock transaction. This often applies to transacting with large listed companies. And they are not subject to capital gain tax until the stock has been sold. Right? So this is the advantage of a stock transaction. And the second type of exit strategy is called, sorry, the third one is called sell back, right? Basically, it sells back to the entrepreneur. So it is also referred to as the recap, and the entrepreneur will own 100% after the sale. In this case, balance sheet of the company will change, right? Because if you sell the company back to the entrepreneur, then in that case, entrepreneur has to pay for it, right? So in that case, the entrepreneur has less cash, right? And also the entrepreneur might increase liability, right? Because I mean, if the entrepreneur want to buy back their company, right? In that case, they have to, if they don't have enough cash, then they have to borrow. Now, in that case, the liability will be increasing. But sometimes it will be harder to convince lender because usually sell back, it's not, I mean, it's not good compared to the IPO, right? So this will pose the question why the company does not go to IPO in the first place, which might further question the company's ability to pay back the debt. Right? So in that case, the VC might have to accept equity to debt swap. Right? For example, the VC, uh, so the entrepreneur borrows from VC, right? And then they borrow the money to buy VC's equity, right? In order to fully own the company, right? So then this is a typical equity to debt swap. And this sell back strategy can also be used by entrepreneur to exit, right? I mean, on the other hand, entrepreneur can sell the company back to the VC, right? Because VC also has substantial ownership in the firm. The fourth exit strategy, which is the most dreaded form of exit. It's dreaded because it's the worst way to exit from the firm. So it's the worst form of exit, but it could be worthwhile if the VC provides debt financing, debt funding, right? So in that case, if the VC provides debt funding, then if the entrepreneur firm is not doing well, then the company can file for Chapter 11 protection. This is the bankruptcy protection, and it is usually the start of reorganizing the firm. So in that case, Chapter 11 protection can squeeze out existing shareholders. meaning that existing shareholders' benefits could be sacrificed. And on the other hand, the debt holders can be forced to become the new shareholder because the company is on the verge of bankruptcy. But the process of the reorganization, it all depends on the bankruptcy cut, right? So it depends on how the bankruptcy cut and how the creditors and the shareholders they coordinate to solve the issue to reorganize the firm. And during the process, the entrepreneur firm can also liquidate their assets, and this could be a profitable form of exit. Or I mean, if you liquidate the assets, you might get some income. And this has been increasingly used by biotech companies, right, as a way to exit. So in terms of exiting strategy, it could be partial, it could be full exit, right? So partial exit, for example, it could be partial private sales, right? You just sell part of the firm to another firm. And also partial exit could be funding rounds, right? You can sell your stakes to another VC fund, right, and then quit. But this could be done during the funding rounds. And this can be used to reduce the information gap between the VC and the buyer, right? Because you don't fully sell the firm. So that's why by buying, by kind of transferring ownership gradually to another buyer, right? The buyer can gradually learn about the firm. So this can reduce the information gap. Also, if you do the partial exit, it can signal that VCs are not overpricing the firm because they are not selling everything. Right? And usually VC funds, VC capitalists, they often use partial exit to signal quality, right? I mean, if I sell the company as a whole, then I might be overpricing the firm, and the buyer might not know about the firm, right? Because they might not get the full information of the firm. But if the VC funds they are selling partially of the firm, then this creates a signal, right? Because I'm not overpricing the firm, I'm just selling some of the parts. And by selling some of the parts, the buyer can also learn about the entrepreneur firm gradually. And on the other hand, you could do a full exit, which is called grandstanding, right? In this case, VCs will try to overprice the firm and sell to the public, right? But they do so in order to make their returns look good. And going IPO in this sense, this is a full exit, right? And then VCs can use the large short-term return of the IPO, meaning that maybe the firm go to IPO, then the VC quits, right? And then they earn a lot. In that case, they can use the large short-term return of the IPO to impress bond providers. Usually, VC-backed IPO, they are often regarded as having higher quality or less uncertainty. That's why if you want to go to if you want to bring your firm to IPO, then you got to make sure this is a success, right? So that's why, because VC business is to bring private firms to IPO, it is important to build reputation capital, right? Because they care about reputation, that's why they will make sure that the firms they bring to IPO are good firms. Right? But because building reputation is important in this business, that's why if you just have one-time gain from behaving in those opportunistic way, for example, you overpriced the IPO. In our case, it will lead to a rejection of future IPOs by public market investors. That's why it is important to build a reputation. So empirically, researchers have found that VC-backed IPOs they issue shares at a lower discount than non-VC-backed IPO, right? Meaning that they are truly, I mean, they don't actually overprice the shares of IPO. And otherwise, when they issue shares, they will have a higher discount. So now let's talk about initial public offering. We're going to talk about the process, the advantage or disadvantage of IPO, and finally IPO and the pricing. So IPO is a process where, for the first time, a private company becomes public. It is also the first time the private firm's equity claims become tradable, and its ownership structure becomes dispersed. The value of this private firm is also determined by an active price discovery process, right? You rely on this efficient financial market to determine the price. So among the first steps, usually the VCs or venture capitalists, they will try to help the startup firm, the entrepreneur firm, to connect with the investment bank, right? Because the investment bank will play the role of underwriter here, right? Now, after the VC help the company connect with the investment bank, then the company will appoint the main managing underwriter, right? So, which is also called a book runner, and that could be co-manager. So in that case, there will be underwriting syndicate forms. So what's an underwriting syndicate? It's usually a syndicate of investment bankers. So each investment bank in this process is called underwriter. So then the company will make arrangement with underwriters, right? The arrangement will include agreement on a spread. A spread meaning the commission you give to the, kind of benefits you give to the investment banker, which is typically 7% for medium-sized IPO, right? And also this arrangement includes a greenshoe option. This greenshoe option allows the underwriter to increase the number of shares bought by 15%. Right? And then the company will register the issue. This issue meaning the issuing of the new shares, right? They register the issue with SEC, and they will also issue a preliminary prospectus. Right? So this prospectus provides very detailed information about the company's background, about the potential offer price the company is thinking about to offer, and also why the company goes on IPO. Right? And after that, the investment banker or the underwriting syndicate will arrange a roadshow, right? They will arrange a roadshow to market the issue to potential investors. In that case, the managing underwriter will build the book of potential demands. And after that, SEC approves the registration, company and the underwriters, they will agree on the issue price. And then underwriters allocate the stock, right? Underwriter allocate the stock to institutional investor, to those or other public market investor. Then the trading starts, right? Underwriters cover short position by buying stock in the public market or by exercising greenshoe option. Greenshoe option meaning that they can increase the purchase of the shares. And after the managing underwriter makes liquid marketing stock and provide research coverage. This is the typical main step. And in the underwriting arrangement, the investment bankers, they will purchase the security from the issuing company and then resell them to the public. On the other hand, the issuing company sells the security to the underwriting syndicate for the public offering price, less a spread that serves as compensation to the underwriter. Right? So in this process, you can see investment bankers, they make profits on helping the private firm issue the new shares. So roadshow. So roadshow is a process where basically the company and the investment bankers, they try to advertise their stock, right? So that potential investors or institutional investors, they become interested in the stock and then buy the shares of the new IPO stock. So this roadshow happens after the SEC has commented on the registration statement and the preliminary prospectus. Then these documents will be distributed to the interested investor, and investment bankers will now organize a roadshow. This is to try to publicize or advertise the imminent offering. In the first place, they generate interest among potential investors and provide information about the offering. And then second, they provide information to the issuing firm and then its underwriters about the price at which they will be able to market the securities. Right? So this is a roadshow. So in the roadshow, there is the book building process going on. Basically, large investors, they communicate their interest in purchasing shares of the IPO to the underwriters, right? And these indications of interest are called a book. right? So when you are building a book, you're essentially building a interest among potential investors. And then the book provides valuable information to the issuing firm because the investors, especially institutional investors, they often will have useful insights about the market demand for the security, right? As well as the prospects of the firm and its competitors. And in this book building process, investment bankers, they frequently revise their initial estimate of the offering price and then the number of shares offered based on the feedback from the investing community, right? If the investment community has little interest in the stock, then the investment banker will try to revise down the offer price, right? And also issue less, right? So how do we select? How does the company select the underwriter? Right? So this usually depends on the reputation of the investment bank's analyst in covering the industry sector of the listing firm. Right? So then it will have more credibility with a bank who understands the company. Right? For example, if the bank, for example, has lent money before to the company, right? And so in this case, the bank will know a little bit about the company, right? And if also the bank might have other business with the firm. In that case, the bank will know more about the company. So basically, I mean, one of the things that those kind of buy side, those investment bankers, they typically approach the company, right? So sometimes they will use the quality of their analyst, right, to pitch the deal, to get the opportunity to underwrite the IPO, right? So they will say our analyst to get a star analyst ranking. So they will uh, our financial analysts are recognized as star analysts. That's why they will try to use this one to pitch the deal. And company, when they choose the underwriter, they also follow this principle, right? And also, it is important to select an underwriter that has the commitment to provide post-IPO analyst coverage of the stock. So because this analyst coverage is important for post-listing valuation of the firm, right? And usually VCs cannot sell immediately after the offering. Yeah? That's why they will worry about the post-listing price. That's why they want to get some credible underwriter so that these analysts will provide some kind of good coverage after the IPO, immediately after IPO. Right? So if you have analysts covering the firm, then the analysts will increase investment knowledge of the stock and decrease the cost of capital. Right? This provides benefits both for the company and also for the VC. So they usually look at the performance of the past IPOs underwritten by the investment bank, right? In order to choose a good underwriter. In many cases, you will have a syndicate where you have multiple underwriters, right? Typically, a smaller bank with specialists in the target firm industry, accompanied by a large bank with strong marketing and distribution networks, right? And there could be many other investment banks being recruited to join the syndicate, right? And these syndicate or these underwriters, they will conduct due diligence to determine offer price and prepare regulatory filings for enlargement. So the roadshow is usually for the management team and the investment bank to kind of market and get a sense of how to price the offer. And the book building process is employed in the majority of the cases, and usually the price are determined after those marketing events, after this roadshow. And in the underwriting process, there will be contractual arrangement. So in this contractual arrangement, the firm will make commitment, right? So then the underwriter commits to sell all of the shares at a set price. The set price is determined until the night before the offering based on the information gathered about likely demand, right? So this determined before the IPO date. And also the firm also has to commit, right? Firm has to commit best effort. So I mean, it's not like it's not like we have to issue the IPO, right? So we will try the best, but if the demand is insufficient, then the offer could be withdrawn. Right? And also, there could be no limit on maximum number of shares sold. Right? And there also, underwriter has to make post-IPO commitments, right? For example, they should try to stabilize the price after the IPO, right? So they can exercise the green show option to sell up to 15% more of the offering, which can be bought back by the underwriter to prop up the price. This is to stabilize the price. So the advantage of IPO is they provide the public company, the IPO firm, with access to additional capital. So in our case, the company's growth is not just limited by cash resources. It also increases the negotiability of the capital. The owners of the firm might want to cash in their investment as much as the VC, right? They want to quit the firm and sell, and there will be a new CEO appointed, right? So this will become a public firm. And also, this enhances the corporate image. They can attract and retain key personnel. Of course, there could be disadvantage, right? For example, there could be dilution of control of existing owners. And they can introduce additional responsibility of directors, right? Those responsibilities include managing the public shareholder company. Also, you have to disclose more to the public now because you are not now a public market investment target, right? Public market investor, they want to know as much as they want to know more about you. That's why you have to disclose more. And then this disclosure creates a cost, right? Because your competitors also get that kind of information. And that could be insider trading implication, right? So for example, if the insider, they know about the secret information of the firm, they cannot trade based on that. And also there could be agency problem, right? Because in a public fund company, the ownership and the control, they're separated. That's why managers, they're no longer owning 100% of the firm, right? Shareholders, they own most of the firm. So in that case, there could be free riding problem, right? So for example, outside investors, they do not have the incentive to monitor the firm, but they get the benefits of good monitoring, right? So, and also agency problem that we just talked about, right? So agency problem means that managers might maximize their own benefits, right? Because I mean, they don't own they don't fully own the firm. That's why they just want to maximize their own benefits. Also, markets appetite for IPOs can change quite dramatically, right? And that's why, I mean, if you prepare to go IPO, right, it's possible that at the time when you go to IPO, the market has no appetite for IPO, right? So meaning that the market reaction for IPO might not be that good, right? So in our case, this creates a cost because if you withdraw from IPO, then this will affect your reputation, damage your reputation. So there could be other disadvantage of IPO, right? For example, there will be fixed cost of listing. You have to pay underwriting fee to your investment bank. Yeah? And there could be underpricing, right? So underpricing meaning that there could be a difference between the offer price and the first day price. So this is a cost because this is the undervaluation of the firm, right? Then the firm obviously is not at the correct value on the first day. So the cost of discounting the offer sufficiently to generate the amount and ensure the success of the IPO. Right? So this is like the company has to pay this in the price in order to attract the demand and then to ensure the success of the IPO. Right? And on average, the underpricing is about 20%. In some countries, it's more. Right? So now we're going to talk about IPO underpricing. So the more mature a firm is, the less underpriced it is, right? IPO underpricing usually refers to the fact that on the first day of the firm goes on public, it usually has a dramatic, very positive first day returns, like 20%, 30%. And new firms are more underpriced, right? So about 70% of US IPOs, they're underpriced. So in that case, I mean, if the issue was not miss the price, then these proceeds will some of it will go to IPO's owners, right? The company's owners. So essentially, the company owners are just paying those underwriters. I mean, compensating those underwriters or institutional investors. So, for example, Yahoo's IPO in 1996, the offer price was 13, yeah? And the company was making losses at 600,000. On the first day of the IPO, the stock price jumped to 43 and then ended at 33. So there are significant underpricing. And also Netscape, right? Netscape went on IPO on 1995, right? Offer price 28, closed at 72. That's a dramatic underpricing, right? And Melvin IT, 1990, right? So offer price $1, closed at nearly $4, right? And also Qihoo 360, right? So this went on IPO 2011. And this company sold 134%, right, on listing on NYSE. Significant underpricing. Right? So here are some quotes for the here are some quotes for the IPO first day return, right? So for example, a good example, GM IPO, a good day for Obama's auto bankers, right? So and also bad day for IPO, L-Octane tables on the debut, right? And also like AG Bank makes lackluster China debut, Alibaba freezes day after Hong Kong IPO. Right? So these are some evidence of IPO first return. On average, we have strong evidence of IPO underpricing. Right? So in markets without daily price limits, most of the underpricing is evident by the closing of the offering day. Right? But if we compare underpricing across country, underpricing is relatively low in France and Germany and relatively high in Asia. Right? So this graph shows the IPO underpricing in US, right? Which is on average about 20%. In China, it is significantly more, right? You can see it's on average it's about 100%, right? Or 100 to 200%. So in Asian market, it is significantly more than pricing. Now we're gonna explain why IPOs are underpriced, right? We're gonna offer a couple of explanations for IPOs, why IPOs are underpriced. The kind of main explanation here is the asymmetric information. Of course, there could be other explanation as well. So basically, a low offering price on an IPO day raises the price when it is subsequently traded in the market, and also it enhances the firm's ability to raise further capital. Now, because it's a good signal to tell the investor that the company is in the price, right? It's a good signal. And in that case, uninformed investor who cannot distinguish which issues are attractive or not are exposed to the winner's curse. Right? This is asymmetric information because in the IPO process, there could be informed investor who know the quality of IPO, and then there could be uninformed investor who does not know the quality of the IPO, and they will usually pay more. Right? Now, in that case, if you underprice the IPO, this will help to retain the uninformed investor, right? So that they don't overpay. So basically, underpricing is trying to attract the uninformed investor. Right? And also, underpricing is largely in the interest of the underwriter, right? They want to reduce the risk that they will be left with unwanted stock, and also to gain popularity by allocating the stock to favorite clients. Right? Let's look at asymmetric information explanation in greater detail. So there could be informed versus uninformed investor on the market. So informed investor, they have better chance of getting shares of good or high quality IPOs, right? Uninformed investor, they are crowded out of good offers and will lose money on average. But because uninformed investor, they don't know the true quality of IPO. So in our case, if IPO, they are not underpriced, then the uninformed investor, they will stay away from IPO. Right? I mean, if they don't gain from the IPO, they don't gain from investing this IPO stock, they will shy away. Then if they shy away, then you don't have sufficient demand, right? Because I mean, of course, in institutional investor, they are a big chunk of the buyers, but equally or even more a bigger chunk of the investors, they are retail investors or typically informed investor. That's why you want to make sure that on the first day they also make money, so that the demand for your company shares is sufficient. That's why the IPOs need an uninformed investor to make up the number, right? Or in other words, make up the demand. So in general, uninformed investors, they bid not according to the quality, right? So they just assume that they will assume that the IPO has the on average the same quality. That's why they will not bid on the quality, because they don't know about the true quality. So what's a weak IPO? Weak IPO is where there's only an uninformed investor bidding the process, right? And then they will lose money and then leave the market. So that's why the underwriters will need an informed investor to participate, right? To solve the problem, the underwriter will underprice the IPO, and then to make sure that underpriced or uninformed investor, they make money on the first day. And the book building process here is intended for the underwriter to assess the demand and obtain price information, right? And also, in order to incentivize investors to disclose sufficient information, underwriters, they will allocate fewer shares to potential purchasers who bid low, right? So that's why if you underprice the IPO, you also encourage, right? You also encourage your buyers to bid more, right? If you underprice it, then it is better to gauge the true price, right? So in our case, I mean, if the true price is like $50, right? You kind of set the price at 40, then it will be easier for you to, I mean, it will be easier for the institutional investor, for the buyer to kind of bid, right? Because if they submit a bid, then it will be sometimes like about 50, some around 50, right? So in that case, if you set a 40 offering price, then it will encourage the potential investor to submit the bids, right? This way, you help the investors to review the information, or review their valuation of the firm. There's also signaling explanation here, right? So there is asymmetric information between the issuer and the investor, right? So this one we already said, right? So investors, they do not know as much about the firm as issuers, right? So in that case, high quality firms, they will try to underprice to distinguish themselves from low quality firms. Because high quality firm, they will sell a small amount at a low cost to signal that it is high quality, and then the remaining value goes up, right? So low quality firm, right? Because low quality firm, they're already at low quality, right? So how are they gonna sell their shares, right? They're gonna sell a lot overpriced, right? That's why it does not care about the value of the firm afterwards, right? They just wanna, I mean, catch the first day return and go away. So by distinguishing high quality IPOs from low quality IPOs, the high quality firms, they can actually recover the cost underpricing through better prices in the future share issues, right? Through SEOs. SEO is called season equity offering, right? So in that case, in the subsequent season offerings, the market realizes the quality of the firm. That's why the firm will gain some, they will recover some cost of the underpricing. But for low quality firm, they cannot afford to do so, right? Because they already sell the overpriced share. So after the IPO, the market realizes their true quality, right? So that's why the low quality firms cannot afford to do the same. And in that case, you can see underpricing as a signal for quality. Yeah? There's also a information cascade explanation. Right? So information cascade explanation is saying that there is also asymmetric information between underwriter and the institutional clients or potential institutional buyers, right? So in our case, informed investor, they will often infer prices from observing the behavior of other informed investor, right? So in that case, the offer price is originally set by gauging demand from prospective institutional investors, right? So in that case, if these investors, they review their true demand, then they risk a high offer price being set, right? So in that case, you can see intentionally to set a low price, right, in order to kind of to kind of induce the info investor to follow, right, to kind of follow their action. So in our case, if they indicate low demand for those um, for those retail investors or info investors, if they indicate low demand, they might be outbid by other investors. So the best strategy for them is to wait and see. So in our case, underwriter to reward their clients with allocation and then pricing for revealing their interest. Or in other words, like it's similar to the explanation I just talked about, right? To kind of induce the truthful bidding from the institutional buyers, right? So and then because these interests from these initial clients, those big institutional buyers, they will have a cascade effect, right? Because if I see a big and a prominent institution buying the IPO stock, I'm an informed investor. I will typically follow their action as well. And there could be also strategic underpricing by the writer, right? Because there could be asymmetric information between issuers and the writer. So in our case, underpricing it's a reward to underwriters, right? Underwriters they're intentionally underpriced to lower their marketing costs, right? Because they don't have to. I mean, they don't have to market if they promise that the first day return is really high, right? And also, they can reduce the risk of underwriting. Right? The risk of underwriting is the what if they cannot sell off their shares, right? Sell all of their shares, right? So in that case, if they're underpriced, then they can make sure they can sell all of their shares, right? So and also underwriters they can use the underpricing to exchange for some return favors from other clients. Right? This is the benefits of underpricing. And there are also other explanation. For example, lawsuit avoidance, right? So I mean, if the investor sees the stock prices goes down on the first day, they might sue the company for not disclosing enough information. You know? Then this can also be political reason, right? Government underpriced the privatized IPO to leave a good taste. And there also could be a reason for building a liquid secondary market, right? For example, if on the first day your stock goes down, then nobody wants to buy your stock. Then the liquidity of your firm stock will be will be in bad situation. That's why you want to underprice in order to induce lots of share trading. In that case, in that case you will have a liquid secondary market, right? Investors will feel free to sell their shares. So in that case, the issuer can then allocate the shares to many small shareholders. Right? This will create a dispersed ownership. So on the macro level, IPO has its cycle, right? Just like MA has its wave, IPO also has its cycle. You can have a hot IPO market, whereas the market sentiment is very good for IPO. Right? You can also have a IPO cycle, or you can have a down cycle, which is where the IPO is not very favorable, as investors do not like IPO. So this is just like a merger acquisition, right? So because in merger acquisition, you also have waves, right? So in a hot IPO market, in a hot IPO market, you will have a larger volumes of IPO, right? In that case, you will also have higher underpricing, right? And this is followed by greater underperformance. So in a hot IPO, because investors they are frenzy about IPO, that's what there will be also greater IPO, greater underperformance. And also, this coincides with the cold cycles in merger acquisition and the liquidation activity, all right? Because um, because it's either the market has merger acquisition going on. If there's not much merger acquisition going on, then there will be new firms going on the market, right? They often coincide with the cold cycle of MA, and they could be specific to an industry, right? For example, during the internet bubble, there's the IPO that this was a hot IPO market. Also, biotech IPO also have a very hot IPO market during 2001 and 2002. Yeah. They're very specific to an industry. So some explanation of the IPO cycle, right? IPOs, they are very sensitive to market condition or market sentiment. If the market is not doing good, then the IPO will not have good first day return. That's why when the economy is growing, the entrepreneurs, they get optimistic and want to grow an IPO to raise money. Right? So, and also when economy is doing well, when the market is doing well, entrepreneurs often also overvalue their company and will only get those high valuations when a company is doing well. Right? This is also the reason. So finally, we're going to look at IPO long-term performance. For example, the stock price return, accounting returns, right? We also in general find underperformance for IPO firms. Right? So this classic paper by Jay Ritter, uh, Jay Ritter, 1991. This is a JF paper, right? So they focus on the US IPO market, right? And in general, they find that IPO's raw returns, they're positive, right? But if you compare the IPO firms to firms in the same industry and with comparable size, IPOs firms still underperform, right? They underperform by a factor of 0.831. Right? So in general, their finding is that IPOs, they are good short-term investment, but they are bad long-term investment. Right? In general, they find that a couple of factors that affect IPO performance, right? For example, size, age, volume of issues, right? So this is the proxy for issuing cycle, and also contemporaneous stock market condition, right? And also young small firms, the issue in the home market tend to do the worst in the long run, right? So they initially has very high underpricing, but then in the long run, they underperform. Right? So, I mean, this in other words, they kind of imply that investors actually overreact on the first day, right? So in general, studies, they find that there's a decline in the IPO's operating performance, right? They also have poor performance than the benchmark, like industry median or the performance of similar firms, right? And but despite those poor performance, IPO firms, they also have higher growth in the sales, right? They also have large capital expenditure, right? So they're typically growing firms that are overvalued, right? So operating performance is also positively related to the retention by original owners, right? This is the accounting return. So some explanation for the underperformance here. So firms seek to go IPO in the best market condition, right? So this underperformance, it could reflect the market cycle. Yeah? So at the time they go to IPO, this is a good market. Market sentiment is really enthusiastic to IPO. But in the long run, the market goes back to normal, goes back to rational, right? That's why they correct the overreaction in the first place, right? And the over optimism, right? So market is inefficient with respect to new firms, right? So market is not efficient. For example, this new firm is very famous. There's lots of advertising, there's lots of news about this firm. So that's why investors easily get enthusiastic about a firm. Right? So that's why they overreact on the first day. Right? Also, when a firm goes on IPO, there could be agency problem, right? So the owners of the firm no longer try to maximize the benefits of the firm, right? And also large institution, right? They can, I mean, drop their commitments after the first day, right? I mean, they can buy on the stock on the first day, but then sell the stock maybe a couple of days after the first day of IPO. Okay? Finally, there can also be an earnings management, meaning that IPO firm, they will try to make the numbers look good before the IPO, right? In order to make the financial performance look good for the investor, right? But they cannot manipulate the numbers always, right? Forever. That's why after they go IPO, they have to adjust the numbers down, right? In order to reverse the earnings management, right? This makes the performance look bad, right? Look underperforming relative to other firms. Yeah. Okay, this is so much for this chapter.